In Chapter 15, we'll be dealing with financial statements, and there are two accounting concepts that will be covered. Adequate disclosure, which basically you're providing information about the business's financial condition and the progress of operations. The second concept is consistent reporting. You want to be able to compare financial information for more than one period. This helps owners make sound financial decisions. Using the same procedures, reporting methods is important for financial state preparation. We previously prepared financial statements, a balance sheet, and an income statement. Again, as a review, balance sheets cover assets, liabilities, and owner's equity or stockholders' equity for a corporation. The income statement reports the business's financial progress, revenues minus expenses. The income statement will be expanded in this chapter to include cost of sales, the products that we're selling. The new financial statement we will be learning in this chapter will be the statement of stockholders' equity, and this will cover capital stock and retained earnings, which is previously earnings from your income statement. When you're preparing your income statement, all of the information will be gathered from the income statement column of your worksheet. But in addition to that, you're also going to be using merchandise inventory, which inventory is an asset, and it will be used in the calculation of cost of sales. On the income statement for a corporation, there are three parts that you will use. You'll have your revenue section, going down from your sales down to your net sales. Net sales are going to be using your component percentage, and everything will be related to net sales when we compare ratios between our different accounts. The second part of the income statement is the cost of merchandise sold, also referred to as cost of goods sold. Taking the difference between your net sales and your cost of merchandise sold, you calculate out your gross profit on sales. The third part of the income statement is the expense section. We'll be learning how to prepare a corporate income statement by completing Work Together 15.1, which is on page 454 in your books. All of your calculations when we prepare the component percentages will be done to the nearest tenth of a percent. So we previously said the income statement is broken down into three parts. We're going to begin our income statement for the first section by preparing the sales section. You're going to look in your income statement column, and your sales are $548,989.25. You also have sales discount and sales returns and allowances. These accounts are contra accounts to sales, and they're going to reduce the amount of your sales, as you'll see in the first part of the income statement. Your three-line heading for an income statement still remains the same. You always will still have your who, your what, and when titles. Company name, what you're preparing, and the time period. Remember, on an income statement, you use for the year ended, for the month ended, because income statements cover a period of time. You have several columns going across your document to prepare your income statement. Your sales is going to be shown up in the third column. This amount came from the credit column of your worksheet on the income statement section. You're also going to deduct your contra accounts. That's why the word less is in written in there, and you're going to be taking away your sales discount and your sales return allowance. Since these two numbers are going to get added together, you carry them over to the left so you can subtotal them, making sure that you place a line with your subtotal, and the total of these two numbers is added together to get 4,174.53. Sales discounts and sales returns reduce the amount of sales, so we're going to calculate out our net sales, taking 548,989.25 and subtracting 4,174.53 to get our net sales. A component percentage is basically the relationship of one financial statement item to another. Everything is compared to net sales. So sales are going to be 100% of net sales. And you can just go ahead and write that under your percentage of sales. So we've just completed the first section of the income statement. When you have a business that sells a product that they had to purchase, you need to add a new section to your income statement, and this is called cost of merchandise sold. The accounting concept covered under this is the historical cost concept, calculating out the cost of your product. There's a simple formula that you can use to remember the cost of goods sold calculation. You start with your beginning inventory, and beginning inventory will be found in the trial balance part of your worksheet. Because remember, the first two columns show the beginning of the month activities. The purchases amount are added to your inventory. So you have beginning inventory plus purchases. Think about this. You start out with some material at the beginning of the month. You buy some more inventory. That's going to add to the amount that you have available to be able to sell. So your purchases amount is going to be found on the debit column of your income statement, part of your worksheet. So beginning inventory plus purchases, and this is going to be net purchases because you may have purchases returns or purchases discount, which are contra accounts to purchases, but overall you calculate out your net purchases. This beginning inventory plus purchases is merchandise available for sale. And the last part of the calculation is to subtract your ending inventory. You could also subtract cost of goods sold if you needed to determine your ending inventory. So, beginning inventory plus purchases minus your ending inventory. And ending inventory will be found on the balance sheet column of your worksheet. Because remember, on your worksheet, the balance sheet shows you your ending values. We'll walk through this on the work together problem. In going through the simplified calculation to determine your cost of goods sold section, we're going to pull our beginning merchandise inventory. Again, remember this is going to be on the trial balance section. Looking at merchandise inventory, this is the value of our beginning balance, $198,480.33. So our beginning inventory plus our net purchases. Our purchases, remember, are going to be in our income statement column. And we have purchases, purchase discount, and purchase returns. We want to be able to get our net purchases. So our net purchases in a simplified form will be the total of $1,845.78 plus $3,548.65, adding those two numbers together, and subtract that from your purchases amount of $278,452.39. Go ahead and take a minute to determine that total. So your net purchases should have been $273,057.96. Remember, we had our beginning inventory of $198,480.33. So our merchandise available for sale is $471,538.29. The last step is to take our ending inventory, and our ending inventory again shows up on our balance sheet, which is $188,999.25. Remember our formula: beginning inventory plus purchases minus our ending inventory equals our cost of goods sold, or cost of sales. And the answer is $282,539.04. It might be helpful to always do this calculation on a side piece of paper. On the next step, I'll show you actually how it will look formally on an income statement. But understanding this calculation will be very helpful as you prepare your statements. You previously prepared the first section of the income statement, the revenue part. Now we're going to be preparing section 2 of an income statement, which is our cost of goods sold. You start out by entering a line item title, cost of merchandise sold. Next, you're going to take your beginning merchandise inventory, which will be coming from your trial balance debit column, and inputting that amount into column 3. The next part of our formula is to take purchases. Remember, purchases will include your regular purchase account less any contra accounts, which would reduce our purchases. The purchases amount will be coming from the debit column of your income statement. And the contra accounts, the purchases discount, and the purchase returns and allowances will be subtracted from your purchases to obtain your net purchase amount. Since you're doing a subtotaling, you need to place a line underneath your two purchases amount, contra accounts, add those two numbers together, $1,845.78 plus $3,548.65 to get the deduction from your purchases. Next, you're going to add your beginning inventory plus your purchases to get the merchandise that you have available for sale. The last part of the formula is to subtract your merchandise inventory that you have left on December 31st. The ending value of your inventory will show up on the balance sheet. This is what you have left in your inventory. And if you think about it, it makes sense. You had some inventory at the beginning of the year, you bought some new inventory, and you have something left. Well, whatever you have left has to be the difference coming up with what you sold to come up with that ending value. So if you think it logically through like that, it may be helpful in understanding the formula. That ending inventory will be subtracted from what you had available to sell to get your cost of merchandise sold, $282,539.04. Now we have to figure out our gross profit. And our gross profit is simply taking our net sales, $544,814.72, subtracting our cost of goods sold to give us our gross profit. Gross profit is the revenue remaining after the cost of merchandise sold has been deducted. Management uses this gross profit amount to determine how effectively the business is performing its primary functions of buying and selling merchandise. Again, to review this calculation of gross profit, you're taking your net sales value, subtracting your cost of goods sold to determine your gross profit. This was the second portion of your income statement. We'll finish up by calculating our expense section. The third section of your income statement is going to be your expense section. This is going to be obtained from your income statement debit column. We'll be taking advertising expense through utilities expense if we want to determine our net income before taxes. Now you're ready to do the expense section of your income statement. You're going to list the title along the left edge, expenses, and put a colon after that. Next, you're going to list all of your expenses, which will show up on the debit column of your worksheet under the income statement. Okay, it's in the debit column because remember, expenses have a normal balance of debit, so you would expect them to be found on the debit column of your income statement. You're going to indent them slightly, and you're going to write down the totals from your worksheet. Put them in the third column over. Next, you need to determine your total expenses. So anytime you're doing math on the financial statement, you have to use underlines. So we're going to place an underline there, add up all of these numbers, and the total expenses number will be written in the fourth column over, $184,764.54. Now we want to determine our net income before taxes. You're going to take your gross profit and you're going to subtract your total expenses. And this will give you $77,511.14. Again, we placed an underline here showing that we were doing a calculation, gross profit minus expenses, excuse me. Now we need to put a line item for our federal income tax expense. That tax expense does reduce your net income. You're going to subtract the $14,603.79 from your $77,511.14 to get your net income of $62,907.35. Make sure that you place double underlines underneath that amount, showing that the statement is completed. The part about having your worksheet is that you've already calculated out your net income after federal taxes, and the $62,907.35 shows up at the bottom of your worksheet under your income statement column. Always double check yourself and make sure you get this number when you're doing your income statement.